Howdy there, folks. Welcome into the buy one, get one free 2 videos for me to react to in this one here today. First one up here, billionaires and CEOs unloading stocks. $9 billion in shares sold in the first half of 23. So I want to watch that one, hear what they have to say, react to that, kind of give my perspective, because that is something that always worries folks, like what happens when CEOs sell and things like that, okay? Second video I want to react to is Evercore's Mark Mahaney. That's from an hour ago. Breaks down his top large cap picks. So we want to hear what stocks this man's saying to buy, and I'll kind of give my perspective and opinion. Since I'm recording this while the market's still open, we could take a peek at kind of what's going on out there today. It looks like Nordstrom is the big winner chicken dinner today. Revolve has been rolling all of a sudden very recently here. Got RH, Fubo has been rolling a bit, which is interesting, and PayPal just crossed $70. Chill, PayPal. I'm buying it all the way to 100, but I like it in the 60s even better, okay? Meta looks like, wow, could Meta cross 300 today? Ooh, I don't know. And Palantir continues to roll as well. Let's take a look at some big techs here. Looks like a decent day of big tech land. AMD's looks like the big L for the day. And it looks like Apple a bit, Tesla a bit. So, yeah, interesting day out there. Commodities. I want to take a peek at commodities. I don't like to see all that green. Commodities, coffee's down, copper's down, silver's down. GSG in general up about 1.2%. So in terms of commodity index in general, we're still down year to date. That's great news for us. If you're thinking about where inflation's going, that's phenomenal news. On a one-year basis, obviously down quite a bit more. So even with this massive market rally, commodities are still down this year, right? We can overlay that with, let's say, the Qs, right? And look at this insane divergence here. So on a year-to-date basis, GSG's down 2%. The Qs are up 38%. Well, you can't ask for more than that. You can't ask for more than that, folks, okay? I appreciate everybody joining me as always. We are now 30,000 plus subscribers strong on the channel. And yeah, let's get into it.
There's sort of these concerns about...
We'll save him. Okay, let's go to this one first.
Billionaires and CEOs are unloading stock and at an increasing pace after little activity last year. Our Robert Frank's been tracking that action and joins us with some numbers. Important dynamic to watch, Robert.
Yeah, Carl, very important for investors. The first half rally giving shareholders a chance to cash in some of their chips. America's top billionaires selling over $9 billion worth of stock just this year. Topping the list is the Walton family, selling $4.5 billion worth of Walmart shares. They have sold over $25 billion of stock since 2016.
Okay, so first way I think about this, you know, you hear that $9 billion number, it sounds huge at first. It's like, oh my gosh, the Walton family made up half that. So, yeah, you know what's interesting? I looked at Walmart stock a little while ago, and as a little while ago, probably months ago, and it did look overvalued, I'll be honest. So anyways, I think that's interesting.
That's to stay under their pledged ownership cap as Walmart buys back those shares. Now, most of the biggest sales are in tech. Joe Gebbia, the billionaire co-founder of Airbnb, cashing in nearly $900 million worth of shares. Those are up over 50% this year. Oracle.
Yeah, that makes sense. I mean, travel's been so red hot. I mean, you know, at some point travel's going to weaken, right? And at some point that could be a damper on Airbnb's business model and be a damper on its stock, right? So, you know, long term, like, you know, 5-10 years from now, is Airbnb higher? Probably. But at the end of the day, like, you know, a year from now, 2 years from now, it's very possible Airbnb could be lower potentially, because we're going through such a hot travel period right now that you know it's not going to last forever, right? So it might be an intelligent sale from him.
Stock is up 35% this year. That's made Larry Ellison $38 billion richer, and he's got a little bit more spending money, selling $848 million worth of stock as...
So it sounds like a huge number. Wow, $848 million. But like they just said, his net worth has increased this year nearly $40 billion. So of the amount of money, you know, he's made this year alone, this is an extremely small percentage. Not even of his total net worth, of just like how much he's gained of his net worth this year. Of $40 billion roughly, and he sold 848 mil. You know, what is that on a percentage basis? 2%, less than 2%, something like that, right? So, or maybe a little over 2%. That's a very, very small number, very small percentage of just how much his net worth has increased.
His options exercises. Oracle CEO Safra Catz also selling $470 million, also with her options exercises. Salesforce CEO Mark Benioff, the CEO of Palo Alto Networks, and 3 board members of NVIDIA, also big sellers. Moderna CEO Stefan Bancel selling over $300 million of stock in the first half. That's after unloading about $400 million last year. And finally, Josh Harris selling about $210 million worth of Apollo stock. That's going to help pay for the Washington Commanders with that $6.5 billion price tag. You look at insider buying.
Before we get to insider buying, okay, this needs to be said. Did you hear what this man just said? He's talking about, oh, you know, this guy needs some money for some Washington buyers. Okay, it's very important everybody understands 2 things in relation to this, okay? The first thing is, these people need to do something with some money, okay? They got yachts to support. They got mansions to buy. They've got insane cars to buy and paintings and all this stuff, okay? And so where do you think that money comes from? They need to sell some stock from time to time, right? If you were in their shoes, you would do the same dang thing. It doesn't mean they don't believe in their companies. It doesn't mean they don't believe their companies are going to be worth a lot more in 2 years, 4 years, 10 years from now. They're always going to be selling some shares because they got to support that lifestyle, right? It's like you're not getting any younger. So, like, what are they going to just hold their $100 billion net worth, their $50 billion net worth, their $10 billion net worth till they're, 100 years old? No, of course. They're going to sell some shares as life ticks on. And the good news for them is whatever their net worth is going up is a very huge percentage compared to the percent they're selling, right? Second thing I think is important to remember is, this is a year that, especially if you're in tech, you could actually sell some shares and get decent pricing. Last year, you really couldn't even consider selling your stock because they were trading at such disgustingly cheap prices. It was like a '08 type situation. It was like a 2000 tech bubble type situation where valuations got put on the floor for tech companies, right? Countless companies were 50, 60, 70, 80% discounts. You're going to try your hardest not to sell in a situation like that unless you absolutely need the money, right? So now you at least got a fair time to cash out some shares. So I think those are just important factors to think about when considering, a CEO, oh, he sold $800 million, and it's like, yeah, he's worth $100 billion. Do you think that's that much? No. It's like to put that in reference, it's like you own $100,000 of Palantir, and you sell like $1,000 or $2,000 worth because you need it to pay a medical bill or something like that. Like, that's nothing, right?
Running about half of last year's level.
Robert, to what degree are taxes a factor here? What do you
that's
think?
An important point. I don't want to just gloss over that. That was important.
Half of last year's level worth of Apollo stock. That's going to help pay for the Washington Commanders with that $6.5 billion price tag. You look at insider buying. That is now running about half of last year's level.
Okay, that's important. So basically, insiders are buying about half as much as they were buying last year, right? Which makes sense because are you getting the same discounts you were getting last year? No. Like, last year was a very easy load the boat situation, especially when it came to tech stocks. So I can understand, buying being less this year. That's just bottom line. Heck, I bought less this year, right? Than last year? Yeah, absolutely. There's no doubt. I bought less. I put less money in stocks this year than last year, right? It was more, like, if you know this game really well, when you get in a year like you had last year, especially for tech stocks, you better freaking take advantage of that, right?
To what degree are taxes a factor here? What do you think that thinking looks like right now?
Well, a lot of the tax-driven selling comes at the end of the year. So I think this is really a valuation question. Remember, in 2021, we had record insider sales of $170 billion. That plummeted to $30 billion last year. So there wasn't a chance to really sell at attractive valuations this year. I think if you look at the first half, it's typically more driven by the stock price, which we've seen a lot of these stocks reaching 52-week highs, finally an exit opportunity. And then I think we could see more tax selling at the end of the year.
I mean, they're staggering numbers, Robert. Thank you. Robert Frank.
Yeah, and, I think something, lastly, that's just important here to think about in relation to this, right? They talk about tax selling. That's absolutely a factor. And also do remember, especially if you're an executive at a company, you're a CEO, right? If the company keeps doing better, you're going to keep getting more options, and you're going to keep getting more shares of the stock as the years tick on, right? So sometimes whatever you're selling is just like the compensation you were basically given in that particular year, right? So let's say CEO of XYZ company gets $50 million of, I don't know, options he can exercise that, ends up equating to, let's say, $50 million worth of shares. He sells 50 million, like all he's basically doing is just taking his compensation out, right? So I think that's just an important overall factor to kind of keep in mind there. And obviously, okay, this needs to be said. 2021, we'll always look back at as obviously just the closest thing to a tech bubble type year we had, right? In the way valuations obviously got pushed up on just the entire market and stocks in general. I think the gentleman just said, $170 billion worth of inside selling in 2021. Like, those are numbers, like, you might not hear a number like that for quite some time. Just to be quite honest, even after this massive move up in the market this year, it's still going to be small potatoes compared to 2021. That was a time period. Let's just call it what it is. That was a time period. Next up here, Mark Mahaney is going to break down his top large cap stocks to buy.
Wages in New York City that made you feel Uber was trading more attractively, or something else?
I think it was more that Meta's had a great rally year to date. I think it's well justified. I just think the risk reward just gets a little bit less compelling here. And I like Uber. I like the setup. Despite the fact that it looks like the CFO is going to be departing, news came right after we made it our top pick, so the timing wasn't great, and it does make me a little bit cautious, but not enough to undermine the thesis, which is we got value catalysts coming up in the next 12 months, potential inclusion in the S&P 500, the attaining and the sustaining of GAAP earnings profitability, and I think they're going to start buying back stock. So I got these value catalysts for a name that fundamentally we think is holding up really well, so that made Uber our number one pick.
And where does it, moving Meta not to number 2, but farther down the list, what does that say about either the year-to-date appreciation or...
Before we get into Meta, I've always liked Uber, and it's good they're getting a profitability. But that profitability comes from somewhere, right? The profitability comes from prices going up. Let's just call it what it is, okay? And I got to say, as somebody that goes on Uber Eats and likes to look around at least a couple times a week, I never end up ordering anything because I'm like, these fees are stupid, man. My wife has that Uber One or whatever, so I guess that's a little helpful. But my gosh, like, by the time, and I like to tip the drivers pretty decent, right? By the time you get all the fees, the taxes, the tip on there, you're looking at likely an additional $20 to $40 on top of whatever you ordered, which usually if you order through Uber Eats, usually the price of whatever you order is more expensive than if you actually went there. For instance, like Chick-fil-A is just a very simple example of, like, if I order Chick-fil-A through Uber Eats, it's more expensive than if I actually went to Chick-fil-A, okay? And it's like that for pretty much all the restaurants. You want to, like a sit-down restaurant that you usually just call for to-go orders or whatever. So a lot of times it's like, am I really going to justify spending an extra $20 to $40 on ordering this Uber Eats? So that's where the real, like, they're talking about GAAP profitability and things like that. Believe me, it's from jacking all these fees and whatnot. And, and I'm sure that's going on the ride-sharing side. I almost, hardly ever, unless I'm traveling, take an Uber to like, drive somewhere. And so that's where it's coming from, folks. And so it's just important we understand that. It's going up on price. So I like Uber. I'm just a little worried that, a lot of people are just going to say no. Especially when it comes to kind of the Uber Eats side and how expensive many of these fees have gotten and whatnot.
Your view on Thread potential revenue, which made some news this week.
And the thing I'm worried about for the drivers, okay, is I'm worried about, like, the fees are starting to get so insane through Uber Eats, and I'm sure that's going on maybe in other food platforms as well, right? Or it's going to be going on. The thing I'm worried about is for the drivers, some people just saying, I'm not going to tip, because it's so, so many fees. And that's the thing I'm worried about for kind of the driver's side. So hopefully that doesn't happen and drivers get to collect tips, because from my understanding, that's a good chunk of the money they actually get to make, the ones that are actually getting the food and delivering to your house and whatnot.
Well, the Thread is just fascinating. 100 million users in less than a week. Wow. And what it says something is that that's the power of the Instagram platform. So you start off with almost 2 billion users, monthly users on Instagram. And yeah, you can take 5% of those, 10% of those, and migrate them into a new app, a new communications platform where there probably hasn't been, in all fairness, a lot of innovation in a couple of years. So there's a chance here for Threads to do something really differentiated. I hope they can do it.
Let's see how many followers I'm up to on Threads now at this point in time. I've been posting a decent amount on Threads, and up to 6,000 702 followers on Threads so far. And, I've been enjoying the platform, certainly. I think it's I think what they need to do, honestly, is what Twitter did in terms of they got to put the view counts on there. Because when I speak to different people that are creators and whatnot, they're afraid about engagement because not as many people heart on there as, let's say, Instagram, right? People are kind of used to heart and things and like that. And so if you only get 50 hearts or 100 hearts, like people think like, oh, not that many people saw this. But in reality, it could have been a ton of people saw that. It's very similar to Twitter. Hardly anybody actually likes something on Twitter, right? It's a very small percentage. But it might get, you might get 500 likes on a post on Twitter, but it might have got 100,000, 200,000 views, right? So, I think that's going to be something that happens on Threads. So in my opinion, they would be smart to put view counts on those over time here. I think they should do it sooner rather than later.
But, we'll see. It's still way too early to know. I'm just really impressed by what they've been able to do so far. But in terms of putting Meta as number 3, to me, it's also, I like the setup on Amazon here. And I think if you get any whiff of acceleration in AWS revenue growth, that's the segment that's most underperformed. Yep. That's the biggest driver of the underperformance in Amazon stock, I'd argue, over the last 2 to 3 years. Any sort of whiff of reacceleration, I think there's a lot of upside in the Amazon shares. And I think you are going to get that.
Yeah, if you get any substantial upside in AWS, you'll see the stock up 10, 15% in a day after earnings, if you really get that. Where it's like, wow, AWS is taken back off as far as growth again. 10 to 15% the next trading day, maybe 17% type move.
Reacceleration.
When it comes back to Uber, though, talking about the setup, Mark, when a stock's up 101% for the last 12 months, it doesn't necessarily mean it doesn't have a lot more to go, but sometimes it can give people pause. Why not you?
Well, we had the setup here is that these stocks just got crushed last year for a lot of good reasons, too. Mostly just a dramatic spike in interest rates, but then we headed into a soft recessionary environment. It was unclear how well some of these assets would really hold up. Well, guess what? Uber Mobility and Delivery have both held up really well. I mean, they're more utility-like than discretionary. And then in the meantime, you've had this dramatic gap up in profitability. We finally got free cash flow out of Uber beginning in the June quarter last year. And every single quarter it's marched up. Now, that's not always going to be the case going forward. I guarantee it won't be. But it will be continuing to march up. And you still have a really interesting valuation play here, David. Despite the run up in the shares, I still see this thing as with a 5% free cash flow yield on 24, 7% free cash flow yield on 25. And for an asset, I think it's the only mega cap name that I look at, and maybe across tech, that I think can sustain well north of 20% revenue growth. And we got profitability really ramping up. So you got, much higher than that, like 40% free cash flow earnings EBITDA CAGR. I think it well warrants those multiples, if not higher. So I think there's more of a re-rating coming on Uber. That's why I still like it. And that's why it's our top pick here.
Yeah, I think you sold me on Uber. No, in all seriousness, you guys, I don't know. If you've been following me for a long, long time, I used to actually own Uber stock back in the day. I don't remember making a ton of money off the stock, though. But I didn't hold it for a super long time because at that time they were also unprofitable, and so it was a million other things. But I might retake a look at Uber, see what's there. But them actually getting to sustainable profitability, I think, is massive for the stock price, for investors to consider it, right? And kind of being able to start running some real valuation numbers on this company, kind of thinking about forward Ps, what are they bringing in, in 2025, 2026, and things like that. So appreciate everybody joining me as always. Thanks so much, folks. Thanks for being subscribed here. If you're looking to apply for my private group, fill out an application. That will be pinned comment down there. We'll see if you're a good fit. Much love as always, and have a great day.